In 1988, Warren Buffett did something that confused Wall Street. He spent over $1 billion buying stock in Coca-Cola, a 102-year-old beverage company that everyone already knew, in a market that everyone already understood, at a price that didn't look obviously cheap. The analysts scratched their heads. The financial press called it boring. A few were openly dismissive. Today, that position is worth over $25 billion. Buffett has collected over $9 billion in dividends from it alone, more than 5 times what he originally paid for the entire position, and he still hasn't sold a single share. In this video, I'm going to walk you through the 5 reasons Buffett bought Coca-Cola in 1988, the specific things he saw that Wall Street missed, the framework he used to value it, and what this single investment reveals about how he thinks about great businesses. Reason 3 is the one most investors completely overlook, and it's arguably the most important lesson this investment has to teach. Stay with me. To understand why Buffett bought Coca-Cola in 1988, you need to understand what had just happened in the market. In October 1987, the U.S. stock market experienced its largest single-day crash in history, a 22% drop in one day that became known as Black Monday. The crash triggered a wave of fear that lingered through 1988. Consumer confidence was shaken. Institutional investors were cautious. Most money was moving into safe assets, not consumer staples. Coca-Cola wasn't immune. The company had gone through a turbulent few years. The disastrous new Coke launch of 1985 had damaged the brand. The stock had been weak. By 1988, Coca-Cola was trading at a valuation that Buffett judged to be well below what the business was actually worth. But the business itself, underneath the stock price noise, was something Buffett had been studying for years. He had watched Coca-Cola grow internationally. He had seen the power of the brand, the way consumers in 200 countries chose Coke over competitors not just out of habit, but out of genuine preference. He had studied the economics of the syrup business, where Coca-Cola manufactured concentrate and sold it to bottlers, earning extraordinary margins without the capital intensity of manufacturing. And he had identified something that most analysts at the time were completely missing. Here are the 5 reasons he bought. Reason 1 explains why the brand alone was worth more than the stock price suggested. Reason 3 is the economic insight that Buffett called a dream business, and it's something most investors never learn to look for. Reason 5 is the personal conviction that turned analysis into action, and it tells you something important about when to move decisively. What Buffett saw. Buffett has a specific test he applies to brand strength. He asks, if someone gave me $100 billion and told me to compete with this company, could I do it? For most businesses, the answer is yes. A well-funded competitor can build a factory, hire engineers, replicate a product, undercut on price, and eventually take market share. The moat is real, but it's crossable with enough capital. For Coca-Cola, Buffett concluded the answer was no. Not because the product is technically difficult to make. The formula itself is simpler than most people think. But because the brand association, the emotional connection, and the 102-year history of positive consumer experience cannot be purchased or replicated at any price. Pepsi has spent over 100 years and billions of dollars trying to displace Coke. It has not succeeded. That failure is the moat. Why it mattered. A brand with genuine loyalty has pricing power, the ability to raise prices without losing meaningful market share. Coca-Cola has demonstrated this repeatedly over decades. When production costs rise, Coca-Cola raises prices. Consumers grumble briefly and keep buying. This pricing power is the engine of long-term returns. A business that can raise prices by 3% annually while keeping costs flat is compounding its profit margins every single year, silently, without requiring additional capital investment. What you look for. Apply Buffett's test to every business you consider. If a well-funded competitor appeared tomorrow with unlimited capital, how long would it take them to seriously threaten this business? If the answer is years or decades, you have a moat worth paying for. Reason 2 is about global distribution, and specifically the insight Buffett had about where Coca-Cola's real growth was going to come from in 1988. What Buffett saw. In 1988, most Wall Street analysis of Coca-Cola focused on its U.S. market performance. And by U.S. standards, Coca-Cola looked like a mature, slow-growth business. Buffett looked at the global picture and saw something entirely different. Per capita consumption of Coca-Cola outside the United States was a fraction of US levels. In large emerging markets, China, India, Eastern Europe, Southeast Asia, the company was barely present. But Coca-Cola's global distribution infrastructure, the bottling networks, the refrigeration equipment, the retail relationships, was already in place in over 200 countries. What Buffett was buying was not the current earnings of a mature US beverage company. He was buying the option on what would happen when billions of people in developing markets achieved the income levels to regularly purchase Coca-Cola products. Why it mattered. This distinction between current earnings and future optionality is critical to how Buffett thinks about growth. The market in 1988 was pricing Coca-Cola as if its growth was largely behind it. Buffett was pricing it as if the largest chapter of its growth story hadn't yet begun. Both views were based on the same publicly available information. The difference was the time horizon and the geographic frame of reference. The market was looking at the US. Buffett was looking at the world. What you look for when evaluating any business, ask, where is the current market pricing growth, and where is the actual growth opportunity? If the market is focused on a saturated geography or product line while ignoring an emerging one, that gap between perception and reality is where value lives. Reason 3 is the economic insight that Buffett has called the hallmark of a dream business. And once you understand it, you'll see why most businesses don't even come close. The peak insight, what most investors miss. Buffett has a framework for identifying what he calls a dream business. It has 2 characteristics. It earns very high returns on the capital invested in it, and it can grow without requiring large amounts of additional capital reinvestment. Most businesses fail this test. A manufacturer needs to reinvest heavily in equipment and inventory to grow. A retailer needs new stores. A bank needs regulatory capital. These businesses can be excellent, but their growth consumes cash as fast as they generate it. Coca-Cola's structure is fundamentally different. How the economics work. Coca-Cola does not make the final beverage. It makes concentrate, the syrup, and sells it to independent bottlers around the world. The bottlers add water and carbonation, put it in cans and bottles, and distribute it to retailers. This means Coca-Cola earns its margins at the concentrate level, the highest margin, lowest capital intensity stage of the entire supply chain. The bottlers bear the capital costs of manufacturing, distribution, and inventory. Coca-Cola bears almost none of it. When Coca-Cola grows, when a new market opens, when per capita consumption rises, it does not need to build new factories. It sells more concentrate to existing bottlers or licenses new ones. The incremental economics of growth are extraordinary. Buffett calculated that Coca-Cola was earning returns on invested capital well above 30%, in a business that required very little additional investment to sustain those returns. That combination, high returns, low reinvestment requirement, is what he called a dream business. He has since said that finding one business with these characteristics in an entire investing career is exceptional. Coca-Cola has maintained them for over a century. What you look for when evaluating any business, look at return on invested capital, ROIC, and ask, how much capital does this business need to reinvest to maintain and grow its earnings? A business earning 20% ROIC that must reinvest 80% of earnings to sustain that is far less valuable than one earning 15% ROIC that reinvests only 20%. The free cash flow generation, earnings minus required reinvestment, is the real measure of business quality. Reason 4 is about the management transformation that happened at Coca-Cola in the years before Buffett bought, and why he considered it as important as the economics. What Buffett saw. In 1981, Roberto Goizueta became CEO of Coca-Cola. Over the next decade, he executed one of the most impressive corporate transformations in American business history. Goizueta sold off non-core assets, refocused the company entirely on beverages, restructured the bottling system, and, most importantly, introduced a rigorous focus on return on equity and shareholder value at a time when most corporate America was still thinking purely in terms of earnings per share. He was one of the first major corporate CEOs to explicitly use the language of capital allocation, to ask not just, are we earning profits? But, are we earning profits in excess of our cost of capital? And if not, why are we in this business? Why Buffett valued this so highly. Buffett has consistently said that great management is one of the most undervalued assets in investing, not management in the sense of operational excellence, but management in the sense of capital allocation intelligence. A business with outstanding economics will eventually be destroyed by a CEO who allocates capital poorly, who overpays for acquisitions, who expands into adjacent businesses without genuine competitive advantage, who prioritizes growth over returns. Goizueta was the opposite. He understood that Coca-Cola's job was not to be the largest company in the world, but to be the most efficiently capital-allocated company in the world. That alignment between management incentives and shareholder interests was, in Buffett's view, as much a part of Coca-Cola's moat as the brand itself. What you look for. Before investing in any business, study how the CEO thinks about capital allocation. Do they talk about return on invested capital or just revenue growth? Do they make acquisitions at disciplined valuations, or do they overpay for growth? Do they return excess capital to shareholders, or do they hoard it and diversify aimlessly? The answers tell you whether excellent business economics will translate into excellent investor returns. Reason 5 is the personal one, the moment Buffett moved from analysis to conviction. And it reveals something important about how he makes the final decision to act. The price Buffett paid. When Buffett began buying Coca-Cola in 1988, the stock was trading at approximately 15 times earnings, not obviously cheap by traditional value investing standards. By the time he finished accumulating his position in 1994, he had paid an average of roughly $6.50 per share. This was not a cigar butt purchase. He was not buying at a dramatic discount to book value or at a distressed price. He was paying a fair price, which was, by his own earlier standards, somewhat expensive. But Buffett had evolved. Under Munger's influence, he had come to believe that paying a fair price for a wonderful business was far superior to paying a wonderful price for a fair business. And Coca-Cola was the definitive wonderful business. How he justified the valuation. Buffett's valuation approach for Coca-Cola was based on owner earnings, his preferred measure, which approximates the cash a business generates that can be taken out without impairing its future earning power. At the prices he was paying, Coca-Cola's owner earnings yield was approximately 6.5% to 7%. But, and this is the crucial insight, those earnings were growing at double-digit rates annually, with no meaningful capital reinvestment required to sustain that growth. A 6.5% starting yield that grows at 12% annually is an extraordinarily different proposition from a static 6.5% yield. He also applied what he called a certainty discount. He was willing to pay more for Coca-Cola's predictable, durable earnings than for equally valued earnings in a cyclical or uncertain business. Certainty of future cash flows has an economic value that standard valuation models frequently underestimate. What this teaches. The Coca-Cola investment encapsulates the most important evolution in Buffett's thinking. From Graham's focus on statistical cheapness to a more sophisticated assessment of business quality and long-term compounding. He paid what looked like a full price. He received one of the greatest compounding returns in investment history, because the price he paid was not full relative to what the business would eventually be worth. It was only full relative to what it was currently worth. That distinction between current value and long-term compounded value is the core of how Buffett thinks about every major investment decision he has ever made. 5 reasons. 1. Investment. 36 years of compounding. Let's bring it together. Reason 1. The brand, a moat that no competitor can buy, built on 102 years of consumer trust and genuine preference. Reason 2. Global distribution. The market was pricing Coca-Cola as a mature U.S. business. Buffett was pricing it as a global growth story just beginning its most important chapter. Reason 3. The economics, a dream business. High returns on capital, minimal reinvestment required, expanding margins, and a concentrate model that makes growth almost entirely incremental profit. Reason 4. Management. Roberto Goizueta's focus on return on equity and capital allocation discipline aligned perfectly with what Buffett needed to trust the investment over decades. Reason 5. The valuation, not cheap in the traditional sense, but a fair price for a wonderful business whose long-term compounded value was dramatically higher than any current metric suggested. Here is the deeper lesson of the Coca-Cola investment. Buffett has held the stock through 15 recessions and market corrections. Through the rise of energy drinks, through the health food movement, through multiple attempts by competitors to dislodge Coke from its dominant position. Through all of it, he has not sold a single share. Not because he ignores the news, but because none of the news has changed the 5 reasons he bought. The brand is stronger. The global distribution is more extensive. The economics are intact. The management has been consistently excellent. And the price he paid, in hindsight, was extraordinarily low relative to what 36 years of compounding has produced. The Coca-Cola investment is not just a story about a good stock pick. It is the clearest demonstration in investment history of what happens when you correctly identify a wonderful business, pay a fair price, and have the patience to let it compound. The next video in this series takes a completely different angle, a direct debate between Warren Buffett's investment philosophy and Cathie Wood's, 2 of the most successful investors of their respective eras. 2 completely opposite views on where wealth is created. And the question of which framework is right has significant implications for how you build your portfolio today. That video is right here.